authoritative coverage of industry trends and recent developments. In-depth news analysis that explains these changes and their impact on you and your clients. Useful implementation strategies by leading experts around the nation. From the BISC Education Studios in Tampa, Florida, this is the CPE Network.
The lack of documentation has proven to be a problem for many auditors.
But first, consolidation of special purpose entities may be a requirement for your clients. Hello everybody, I'm Marlene Schneider.
And I'm Stan Rhodes. Welcome to the accounting and auditing portion of our November 2004 program. In a few moments, we'll look at recent authoritative guidance provided by the standard setters. We're pleased to welcome Tom Robinson this month. Tom is an associate professor of accounting at the University of Miami in Miami, Florida. He is a CPA, a CFP, and a chartered financial analyst. Tom is a consultant in the area of accounting, financial statement analysis, investments and valuations for a variety of accounting and legal practices, as well as for professional organizations, individuals, and government agencies. He is also a frequent speaker for the Association of Investment Management and Research at both local and national meetings.
J. Russell Madre joins us this month. Russ is a CPA, CIA, CMA, and a CFM. He is also president of the Madre Group, which specializes in knowledge transfer. Russ has more than 15 years of professional experience, including 10 years in public practice. Russ is the author of numerous publications and articles on accounting and auditing topics, including the AICPA's Compilation and Review Alert.
Tom Radcliffe, director of the School of Accountancy and an eminent scholar in the Department of Accounting and Finance at Troy State University in Troy, Alabama, will be with us as well this month. Tom serves as a consultant to several CPA firms in Montgomery, Alabama, but is a scholar in residence for Wilson Price. Tom has also been named as one of the most prolific authors in 2003, according to the Hasselbeck study.
We begin our program this month by revisiting a complex topic, the consolidation of variable interest entities. Accounting Research Bulletin 51, titled Consolidated Financial Statements, addresses the consolidation of variable interest entities, or VIEs, by business enterprises. This standard has been amended twice by FASB Statements 94 and 144. Additionally, the FASB released an interpretation, FIN 46, regarding the consolidation when one or both of the following characteristics exist. 1. The equity investment at risk is insufficient for the VIE to finance its activities without outside support, and or the equity investors lack one or more of the essential characteristics of a controlling financial interest.
The complexity of what was addressed in FIN 46 was such that the FASB revised the interpretation within a year of it being released. Among the changes that were made was the inclusion of an appendix defining what is a business. For more on this complex document and topic, let's now join Tom Robinson, a CPA, an associate professor at the University of Miami, and a consultant to a variety of entities in the accounting area.
Thanks. Tom, welcome to the program.
Thank you.
Today we want to talk about variable interest entities and the FASB's, what seemed like a myriad of documents on this topic, but they issued Interpretation 46R in late 2003 dealing with the consolidation of variable interest entities. The FASB is also working on a broader business combinations project, which has resulted in 2 significant new standards in recent years, but it's still in process. Why is so much attention being devoted by the FASB to this area in recent times?
Well, this whole area of business combinations, consolidations, and the equity method has actually been an issue for a considerable amount of time. The original standards in this area date from the 1950s and 1970s. Business has gotten a lot more complicated. There are new business entities that didn't exist in the 50s, 60s, and 70s. There are much more complicated capital structures that businesses are using today that weren't used at those times. The FASB knew that this was an issue and actually placed it on their agenda in 1996. And so it's an area that they've been working on for a while, but unfortunately have not made very much progress on. What brought it to light recently were all of the accounting scandals. Companies like Enron, which were not consolidating entities that they had set up for purposes of financing the business and operating particular areas of the business, the so-called special purpose entities. And as a result of the proliferation of use of the special purpose entities, the FASB needed to act quickly, and that's why they revisited it with FIN 46. And now subsequently, because it's a complicated area, they've had to issue a lot more guidance dealing with when do you consolidate, when do you use the equity method, which one is the most appropriate.
Well, why is the issue of consolidation versus the equity method so important?
The equity method, some people refer to it as a one-line consolidation. So in other words, you're reporting your share of the earnings of an investee on the income statement in one line item. So you're basically compressing their sales, all of their expenses, and reporting just your share of the net income. Similarly, on the balance sheet, you're showing your net investment on one line item. So you're basically netting all of their assets and liabilities down to one line item. The problem with that is it doesn't provide transparencies to the users of financial statements. The purpose of preparing GAAP financial statements is to provide information that's useful to investors and creditors for them to make decisions. If they can't see the underlying sales and expenses related to this investment or the underlying assets or liabilities, they don't have full transparency. They can't see through to what's really going on in the business. Additionally, because these items are reported in a condensed fashion, it can actually distort the parent company, the investor's financial ratios.
What other types of financial ratios could potentially be distorted?
The main distortion comes in profitability-related ratios. Since you're reporting your share of the investee's income, but not their share of the sales, profitability is measured a number of ways. But for example, one way is to take net income divided by sales. Well, you've got your share of their net income, but you don't have your share of their sales. So assuming they're profitable, you actually overstate your profit margin relative to what a company would report if they were consolidating or if they did not have an investee. So when you're trying to do a comparison, an investor or creditor, from one company to another, you'll end up with a higher profit margin for a company using the equity method just for that reason by itself. Additionally, return on assets is overstated in the case of a profitable investment because you're reporting your share of net income but not your share of their assets. You're reporting only the net assets as a single line item. So profitability ratios, both profit margin and return on assets, are overstated. The other ratio that is affected is the debt ratio. If you're reporting under the equity method, you're only showing the net assets. You're not showing your share of the other company's liabilities. As a result, the debt ratios look smaller than they would be had you been consolidating. Some would argue that that's okay because you may not be responsible for those debts or obligations, but it's a way of companies like Enron to keep balance sheet liabilities down. So they purposely set up some entities in order not to have to show those liabilities on their balance sheet.
Well, prior to FIN 46 and FIN 46R, what kind of rules governed the consolidation of variable interest entities? Because we said that it had been around since the 50s and in some cases the 70s.
Right. In the case of the 1950s, it was ARB 51, Accounting Research Bulletin 51, which was a pronouncement of the Committee on Accounting Procedure, which predated the APB, which predated the FASB. So we're dealing with a rule that's been around for a long time. And what this rule basically said is that if you had a controlling financial interest, then you needed to consolidate. And it stated that the usual condition for a controlling financial interest was ownership of more than 50% of the voting equity in another company. Notice it didn't say the only condition, it said the usual condition. The issue is that ARB 51 was generally interpreted to mean that the only way that you would have a controlling financial interest is that if you owned 50% of the equity of the other company. And so that is, it's been modified a little bit over time, but that ARB 51 is pretty much the rule that we've been dealing with overall on consolidations until recent years. With the proliferation of special purpose entities, given that there wasn't much guidance in ARB 51 on consolidation, the Emerging Issues Task Force, the EITF, had to deal with some very narrow issues. For example, they issued an EITF on leasing transactions, which basically dealt with the situation where a company set up a special purpose entity or special purpose vehicle and leased equipment from this entity. And in a very narrow EITF guidance, they basically stated that as long as you had an outside investor, a third party, that invested at least 3% of the equity of that special purpose entity, and the transferor, the company that was setting this up, did not have a voting equity interest, they would not have to consolidate. So that's sort of the famous 3% rule that a lot of companies used and actually applied it to other transactions beyond leasing in order to avoid consolidating those special purpose entities.
Well, what kinds of changes did FIN 46 make to the consolidation of these special purpose entities?
Well, FIN 46, what it actually does is present a new model for consolidation. So it really goes well beyond an interpretation, although it is technically called an interpretation of ARB 51. So what it basically does is interprets ARB 51, provides us with a model for when to consolidate what used to be called a special purpose entity. Within FIN 46, they use a broader term, a variable interest entity. And what it basically does is interpret ARB 51 and nullify the previous EITF guidance to provide us with a new model, which essentially has 3 steps. It's not expressed as such in the standard or the interpretation, but what it states is that first you determine whether or not you have an entity. If you have an entity, you then go on to determine if it's a variable interest entity. If you have a variable interest entity, then you go to the next step, which is determine whether or not you're the primary beneficiary. The primary beneficiary, if you reach that step, is the one that is going to end up consolidating the variable interest entity as opposed to using, say, the equity method of accounting.
Well, obviously, as you mentioned, what is an entity is a crucial determination. So what is an entity under FIN 46?
It turns out that's actually the easy one, because an entity under FIN 46 is a separate legal structure. So it's something like a partnership or a limited liability company. To be an entity, it has to be a separate legal entity. So that's to distinguish it, say, from a division of a company or a department of a company. In order to be an entity, it has to be a separate legal structure that is set up.
Well, when is an entity a variable interest entity? Because you said that was one of the other determining
Right. So
steps.
Assuming you've got an entity, then you go on to determine if it's a variable interest entity. And in a nutshell, what the variable interest entities rules basically do is look at whether the equity owners really look like equity owners. So typically the way these structures are set up is a company, for example, Enron was using them for financing, would set them up to have a third party that owns the equity in the entity, and then they have some sort of other interest in the risk, rewards, profits, and losses of the entity. So really what the rules boil down to is this equity investor really like an equity investor? So one of the things they look at is, does the entity have enough capital to stand on its own without getting additional support from an owner or others in order to continue operation? So is there a sufficient equity investment there by those owners? Interestingly, there is a presumption in FIN 46 that you have to have at least 10% of the assets. So that replaces our old 3% rule. So they've raised the threshold to 10. But that threshold can be overcome. So it's not a hard and fast rule, but there's just a presumption that if the equity is less than 10% of the total assets, then it's likely to be a variable interest entity, unless you can come up with some pervasive evidence to the contrary. The other conditions that you look at are whether the owners really look like owners. Do they really participate in the risk and rewards of that variable interest entity? Do they have the right to make decisions that control the fortunes of that entity? So there's some quantitative tests, there's also some qualitative tests. You know, what's the decision-making ability of those owners? What type of voting rights do they have? Are their voting rights proportional to their ownership? Are they proportional to their sharing in potential profits and potential losses of the entity?
Well, one of the other key components that you mentioned was a primary beneficiary. So let's take a look at how the primary beneficiary is determined.
Okay, so assuming we reach the third step, we have an entity, we then determine that this entity is a variable interest entity. What we have to determine is, if we're the ones that have set this up, we're called the transferor. We need to know if we are the primary beneficiary. And the way that that is determined is by looking at the expected losses and expected returns of this entity, and who is to get the majority of the expected losses or the expected residual returns. Whoever gets the majority of those is going to be considered to be the primary beneficiary. Depending upon the structure, it's actually possible that you might have one party that has an interest in this entity that's going to get the majority of the losses, and another party is going to get the majority of the returns. In that circumstance, it's the party that gets the majority of the losses that would be considered to be the primary beneficiary.
Well, what kind of changes were made in the revision to FIN 46? Because they didn't even, it wasn't even out a year before they issued a new statement.
Right. It turns out that shortly after FIN 46 was issued, the FASB and the EITF were asked to provide guidance, to help us understand this. And so there were a number of staff positions that were issued. There were a number of additional guidance to help people interpret the interpretation, try and understand what's going on. So one of the main things that FIN 46R did was consolidate all of those guidance and revisions that were issued into one statement. It also made some additional changes, particularly in the area of scope exceptions. So it clarified some of the scope exceptions within FIN 46 and added an important new exception, and that is in a circumstance whether after an exhaustive effort, someone who otherwise might be considered to be a primary beneficiary is not able to obtain the information they need to make the determination required by FIN 46, there actually is an out where they would not have to apply FIN 46 if they're unable to get that information. Now, that provision, that scope exception, only applies to entities that were in existence prior to December of 2003. So if it's a new entity, you're going to have the information you need. It also is generally considered that if you were the one who set up this entity, that you would have the information. So it's really intended for someone perhaps that ended up with an interest in a variable interest entity at some later date. They weren't involved in setting it up.
Maybe like an acquisition.
Exactly. Or for some reason, some sort of contractual relationship that occurs at a later date. And as a result, they could be considered to be a primary beneficiary, but they're unable to get the information they need to make a proper determination. So it should be a very narrow scope exception, but it's certainly an important one.
Well, you mentioned that they had issued some interpretations on the interpretation. So what kind of recent guidance has been given on the issues that were raised regarding the consolidation of variable interest entities?
The FASB has issued several FASB staff positions, which are a new type of standard that we've had now for, I guess it's about a year and a half. And these are intended to be the positions of the FASB staff on an issue. So it sort of replaces the SOPs of the AICPA. And so some of the issues that preparers and auditors have been struggling with is this concept of expected losses. And so one of the issues that was raised, one of the questions that was asked was, if you have an entity that has never had a loss and is not expected to have a loss, if they're expected to be profitable, could it possibly be a variable interest entity? And it turns out, according to the FASB staff position and a reading of FIN 46R, it is, because the concept of an expected loss is not based upon an accounting loss. It's really based upon the variability of return. So you have an entity that's, let's say, expected to earn $100,000 a month. But let's say it's possible that they could earn as low as $90,000 a month or as high as $110,000 a month. The concept of expected losses and expected residual returns deals with that variability. So an expected loss is really the downside variability. So the fact that the income could be $90,000 instead of $100,000 means there's an expected loss there of $10,000, as it's described in FIN 46. So the FASB staff position basically clarifies that yes, even an entity that's always been profitable and is expected to be profitable can have expected losses as well as expected returns, and hence be considered to be a special purpose entity. One of the other FASB staff positions deals with this idea of, do the equity investors in the residual the ownership of the variable interest entity really look like owners? And that deals with what types of decisions they are going to be making regarding the entity. And so people were looking for some guidance from the FASB, give us a list of decisions. Tell us what types of decision-making authority those equity owners would have to have in order for this not to be considered to be a variable interest entity. And unfortunately, what the FASB staff position concludes is that they can't provide a list of those types of decisions, that you really have to look at the facts and circumstances. And are they the types of decisions that can have a significant influence on the future of the entity? And one of the things it notes is that you should consider, along with that, the equity ownership's percentage interest in the entity. So for example, if that equity owner has a significant percentage ownership in the entity, they're going to be less likely to give up decision-making authority. So where you may find companies that are considered to be lacking the decision-making authority is also probably going to be in an area where that equity owner has a very small interest in the entity, and therefore might be inclined to give up some of their decision-making authority. But unfortunately, we don't have a list. So we really have to look at a facts and circumstances and make some qualitative assessments as to whether or not they have sufficient decision-making authority to make it not a variable interest entity.
We talked a little earlier about the equity method versus a consolidation of variable interest entities. Have they recently issued any kind of guidance on the use of the equity method? Because I know that there's been some discussion about when to use that, and what about joint ventures and that
Right.
kind of...
Yeah, the whole issue of equity method has been something that also needs to be looked at, and it's actually being looked at internationally. In the U.S., if you have a joint venture, for example, and you own 50% of another company, you would typically use the equity method of accounting because you don't have control. You have significant influence, presumably, at a 50% level, but you don't have control. So the equity method in the U.S. would be appropriate. Under international accounting standards, if you have a joint venture where two companies each own 50% of another company, they actually use what's called proportionate consolidation, where they each show 50% of the assets and 50% of the liabilities of that entity. That actually adds to the transparency, because you're basically looking through that investment to see what your share of the assets and liabilities are, and makes the ratios look more normal, not overstated. Unfortunately, we don't use proportionate consolidation at all here in the U.S. I shouldn't say at all. There are some particular industries where proportionate consolidation is used, but for the average company, it's not. Even though many analysts like proportionate consolidation, internationally they're actually doing a study right now on whether or not they should continue to use proportionate consolidation or perhaps use the equity method of accounting. So there's an international survey that's going on the IASB's website dealing with that issue. Here in the U.S., the issue gets complicated because the current standards on the equity method of accounting basically only deal with an ownership interest in common stock. And so the issue came up is, well, what if I have preferred stock, or what if I have some other sort of interest? So the EITF recently issued some guidance that deals with, if you have an ownership interest in a corporation as opposed to a partnership or a limited liability company, when should you treat that as similar to the ownership of the common stock? And what the conclusion basically is in the EITF is, you only are going to apply the equity method if you own either common stock or in substance common stock, which is something that, while it may be called something else, is in substance really looks like common stock.
Well, do they do any kind of definition of what is in substance common stock? Do they give us criteria to follow in that regard, or
Exactly.
any kind of help?
Yeah, they help somewhat, although, again, it's a new area, so it's going to be an area that's going to be probably
Changing.
subject to change and interpretation. But they look at several characteristics of this investment that you have in the other company. One of the things they look at is the subordination status of the common stock relative to this other ownership interest. So if the other ownership interest has a preference over the common stock, for example, let's take the example of preferred stock that may have a liquidation preference. So in other words, if something were to go wrong at the company, the preferred shareholders would get a liquidation preference over and above the common shareholders, then it would not be in substance common stock. There can't be a subordination between the common stock and the other interest. They have to be on a similar plane in terms of those types of preferences. Some of the other things that they look at are the risk and the rewards of the ownership. Does this investment that you have in the other company behave like common stock? So in other words, if the common stock goes up or goes down, does the investment that you hold go up or go down in a similar manner? So an example there might be a deep in the money call option, such that if the stock goes up by $1, the option goes up by $1 in value. Similarly, if the stock goes down by $1, it goes down by $1 in value. So they're looking at not only the subordination status, but does it have similar risk and rewards? And then the third characteristic under the EITF guidance that you look at is whether or not there is some obligation to transfer value to this investment that common stock doesn't have. So for example, common stock typically doesn't have a redemption feature. So if you have an investment in this entity that has a substantial redemption feature where you can be redeemed for some money and the shareholders don't have a similar feature, then it would not be in substance common stock. In a nutshell, what all of these criteria do is they really look at, even though this may not be called common stock, does it behave like common stock? Is it on the same plane in terms of liquidation? Does it have the same risk and rewards? And does it have similar obligations or lack of obligations to common stock? And if so, then it's considered to be in substance common stock. As a result, if you have an ownership interest, then you may use the equity method of accounting for in substance common stock as well as common stock in a corporation.
Well, I want to talk about subordination and what that characteristic involves, but would the dividend on preferred stock, because that's a very common characteristic for it to have, is that
Right.
considered part of the subordination or something along those lines, or is it similar to the risks and rewards part that you talked about?
Unfortunately, that's just an example, and there isn't a hard and fast rule on it. So you really have to look at this at the level of subordination. So, how close it is, how much of a preference it may have over the other. And I think it's going to be more of a liquidation preference as opposed to a dividend preference, because you're right, the norm is for preferred stock to get their dividends sooner. But they may still have similar risk and rewards, particularly if it's participating preferred, for example.
Well, with the subordination, exactly what are they looking at for the characteristics there? Is there something specific, or like you mentioned?
It's basically looking at whether there's a senior interest. Do they have an interest that's above the common stock, and the common stock is therefore subordinate?
Well, as we mentioned before, the risks and rewards, is there something specific there that they're looking for?
Again, what they're looking for there is it's going to be a facts and circumstances test. And one of the examples that they provide in the EITF guidance is a call option. And they distinguish between a call option that's deep in the money, in other words, where you have the right to buy the stock for, let's say $5 and the price is currently $50. Well, it's basically like owning the stock. And so it's going to have similar upside and similar downside. On the other hand, if you have an out of the money call option, it may not have the same risk and rewards. And so they do provide a couple of examples, but again, not a lot of detailed guidance. It's going to be a facts and circumstances type of analysis.
I guess maybe as we get further into the application, we'll see more definitive guidance come out, because that's usually what happens.
These are all areas where we're going to be seeing more and more guidance as time goes on.
Well, what about that third characteristic related to the obligation to transfer value?
Yeah, it's beyond liquidation preference, but the common stock, for example, doesn't have a maturity date. You're basically, the way you're going to get out of it is by selling it. And so if you have a security that you think under the other characteristics looks like common stock, but perhaps there's some obligation to transfer value at a maturity date, so some sort of redemption feature where it can be redeemed for a significant sum of money. In that case, it would not be considered to be in substance common stock. It would have to have similar lack of redemption features to common stock in order to qualify.
Well, we talked about at the beginning how this was part of the FASB's larger business combinations project. So maybe we should talk a little bit about where the FASB is on that broader project at this time.
It's, that project that was placed on the agenda in 1996 is still in process, and they're actually expecting to issue a couple of standards, or at least the exposure draft on a couple of standards sometime in the next 3 to 6 months. And they're really looking at a couple of things. They're looking at actually a revision to 141 on business combinations. So again, we've had some guidance on 141, so they're revisiting some of those issues. And then probably more significantly is how you deal with a minority interest. That's been something where it's typically reported in the mezzanine of a balance sheet. So it's somewhere in this never-never land between liabilities and equity. And so they've actually made a preliminary decision on this, and their decision is that that minority interest should be part of equity. It should not be in the mezzanine. So there are some other issues that they're working on. We do expect to see something by the end of the year on this overall project, but even at that point it probably won't be done.
I have a question about that, and I don't know if you're going to know the answer to this or not, but how is minority interest handled internationally? Is that handled differently than what it's currently handled here in the U.S.?
It's actually handled fairly similarly, I believe, but I don't know 100% under the IASB whether they have addressed this issue. A lot of the projects that are being undertaken right now are joint projects with the IASB. So in the end, I think it will end up looking pretty much like the U.S. because we're working on most of these projects together with the IASB.
Well, thanks.
You're welcome.
Now let's return to the studio.
SAS 62 provides auditors with guidance on reporting on bases of accounting other than GAAP.
That's right, Marlene, and the two most popular forms are cash or modified cash and the tax basis.
Welcome to the next program segment on the A&A portion of this month's program.
In this segment, we will consider issues affecting your auditing practice. SAS 62 was issued in April 1989, over 15 years ago, and yet it still provides auditors with guidance on issuing reports on financial statements prepared under a basis of accounting other than GAAP. SAS 62 provides 4 alternate acceptable bases: 1, a regulatory basis; 2, the tax basis; 3, cash or modified cash; and finally, a definite set of criteria having substantial authoritative support. For more on other comprehensive bases of accounting, let's join Russ Madre, a CPA and the president of the Madre Group.
This has become a widely used alternative to GAAP. A financial statement is prepared under GAAP or prepared using GAAP. Unfortunately, there's not a lot of guidance